Welcome to the ProTicker Deep Dive. So, if you've been following the financial headlines for, the last 2 years, the story has been all about safety.
Mm-hmm. The mega banks.
Exactly, the Goliaths of Wall Street. And meanwhile, regional banks, they were just treated like damaged goods.
Absolutely. Put on the shelf.
But we have been deep diving into the fundamentals, and the data is starting to suggest that the script is flipping. This overlooked sector is showing signs of a massive shift, a shift that could make them one of the most compelling value opportunities heading into 2025.
It's more than just a potential bounce back. I mean, this feels like a fundamental inflection point.
Yeah.
The sector has finally gotten through 3 years of pain, and the whole economic environment is turning pretty decisively in its favor.
So what's the key data point that's telling you this?
Well, what really stands out in the forecast data are the consensus earnings estimates for 2025. We're looking at projected earnings per share growth somewhere between 16.6% and 18.4%.
Mid-teens growth. That's huge. That's the kind of growth you usually reserve for tech companies, not, traditional lenders.
Exactly. And critically, that growth trajectory is expected to exceed the growth rate of the big diversified banks. So this isn't just a marginal improvement. It's a real setup for outperformance.
Okay, so our mission is clear. We need to unpack the three powerful catalysts that are driving this potential redemption arc for the regionals. Let's start with a macro environment. It's really about the end of the pain cycle, isn't it?
To understand the optimism, you absolutely have to remember the agony. I mean, the period from 2022 through early 2024 was just defined by the Fed's aggressive rate hiking campaign. We saw short-term rates hit 5.5%.
Logically, though, higher rates should mean more money for banks, right? I mean, they earn more on their loans.
That's the paradox. And for regional banks, that aggressive rate hike regime really backfired. Their funding costs, they had to pay out to depositors, they just soared. They rely so heavily on those local, relationship-driven deposits. And when rates spiked, those customers either demanded much higher pay or, even worse, they fled.
To things like money market funds, I assume.
Right, to all these high-yield alternatives. So they were just bleeding their low-cost funding base.
And that crushed their net interest margin, their inning.
Crushed it. That difference between what they earn on loans and what they pay for deposits, it compressed severely. But now that entire dynamic has reversed.
Because the economy is cooling and the Fed has officially started its easing cycle.
It has. And here is where the mechanics get really fascinating.
The thing that hurt them is now going to save them.
It is. This is the key concept to remember. Regional banks are kind of uniquely positioned to profit from falling rates because their cost of funding, that interest paid on their massive deposit base, it drops like a stone. It adjusts downward much faster than the interest rates on their existing loan portfolios.
So that mismatch creates profit.
It rapidly expands the net interest margin again. You get profit where you just had compression before.
That's a powerful internal tailwind. And on top of that, we also saw the Fed signal some additional system-wide support, didn't we?
We did. The Fed announced in late October 2025 that it would end quantitative tightening, QT, which is, basically the process of shrinking its balance sheet.
And what's the signal there?
By ending QT and starting to reinvest maturing assets, they're signaling a relaxation on the liquidity front. More liquidity in the system that takes direct pressure off bank funding.
Okay, that covers the massive macro shift. So that naturally leads us to the next question. What happens to the specific operational drivers when borrowing gets cheaper? Let's dive into catalysts 1 and 2. The rate environment continuing to ease and loan demand picking back up.
The consensus runway here is pretty extended. Even if the Fed pauses for a moment, the overall direction is set. We're anticipating 2 to 3 additional rate cuts through 2026.
Which creates a structural multi-year tailwind.
Yes, a tailwind for margin expansion.
And as those rates fall, borrowing becomes more attractive, which that has to stimulate loan demand.
Absolutely. I mean, credit demand was basically dormant during the high-rate era, but now we expect it to accelerate globally. Loan growth is forecast at 6% for 2026.
Which is a huge jump from what we saw in 2024.
It's a material acceleration from that paltry 2% growth. And for regional banks, this is essential. It's where they earn the bulk of their revenue from lending.
So this is all about net interest income, NII, the true lifeblood of regional banking, finally stabilizing and growing again.
Correct. Global banking forecasts suggest NII will resume growth in 2025, expecting about 3% growth compared to zero growth in 2024. And that growth is driven by the margin stabilization we talked about. combined with just more loan volume.
And they showed some real resilience during the tough times.
They did. What's amazing is that even during the toughest part of 2024, community banks, a core part of this segment, they reported remarkably strong 5.1% loan growth and a resilient 4.7% increase in domestic deposits. They held onto their local franchises better than Wall Street ever expected.
Okay, that brings us to catalyst number 3, which is the stark, almost bizarre valuation disconnect. You mentioned this has been described as absurdly compelling. Why is the market giving these banks such a deep discount if they're about to generate double-digit earnings growth?
Because they're being priced for a recession or even a localized failure, that just may never materialize. Let's look at the numbers to see the scale of this mispricing. The sector is currently trading at a price to earnings, or PE, multiple of roughly 11.8x on forward 2025 estimates.
Okay. And what should it be trading at historically?
Well, that's the thing. Historically, regional banks traded at, 90% of the S&P 500's PE multiple.
So a 10% discount. Pretty standard.
Right. But by the end of 2024, that discount had ballooned to an astonishing 55%. The fear is just palpable, and it's suppressing prices.
And what about price to tangible book? Same story. If you look at price to tangible book value, which measures the price relative to their hard assets, it sits near 1.15x. The 5-year median for that is 2.32x. The market is basically pricing them as if their assets have permanently depreciated.
That valuation is compelling, but it only really works if they're ready to capture the returning revenue efficiently. Are they running lean businesses now?
They are, and that operational leverage is a major bullish signal. Regional banks generally aim for an efficiency ratio between 60% and 65%.
Meaning 60 to 65 cents of every dollar goes toward costs.
Exactly. And many key regional players are already hitting or even beating those targets through some really disciplined cost management. So when that NII growth accelerates, that operational leverage kicks in and just magnifies revenue growth directly into faster earnings growth.
And we're also seeing the return of M&A activity helping that efficiency ratio, right? Absolutely. Consolidation is accelerating. It's driven by that desire to capture cost synergies, eliminating redundant branches, merging tech systems, optimizing staff. And it's partly supported by a signaled rollback of some regulatory restrictions on bank consolidation.
Plus, their balance sheets are strong enough to support it.
Their balance sheets are robust. The Common Equity Tier 1 ratio, CET1, they're strong across the sector. It confirms they have healthy capital cushions to manage everything.
Okay, so if the math supports prosperity, double-digit growth, operational efficiency, massive discounts, why aren't long-term investors just piling in immediately? We have to shift to the counter-arguments. What are the concrete risks keeping that 55% valuation discount in place?
The opportunity is huge, you're right.
Yeah.
Mid-teens growth, deep discount, a solid 3.5% to 4.5% dividend yield. But the shadows are real. The biggest wild card is credit quality, and it's primarily focused on commercial real estate, CRE.
We hear about the CRE crisis constantly. How serious is it for this specific sector? Systemically, the risk is probably contained. CRE is only about 10% of total bank loans nationally. But for specific mid-sized regional banks, it can be a localized tsunami.
So it's not evenly distributed.
Not at all. For some of these institutions, CRE can represent 50% or even more of their outstanding loans. So if you're a bank that's heavily concentrated in, say, office properties in major city centers, you could face significant loan losses, even while the rest of the system is healthy. The risk is concentrated, not universal.
Which means identification and stock selection is absolutely paramount here.
Okay, what's the second major risk?
The rate path uncertainty itself. The entire margin expansion thesis, it depends on the Fed continuing to ease. We've heard Fed Chair Powell caution that a December 2025 rate cut is, and I quote, not a foregone conclusion.
Right.
So if persistent inflation forces the Fed to delay more cuts, or worse, even hint at a reversal, that margin expansion thesis weakens immediately and the discount will persist.
And finally, there are those broader macro wildcards that could sour the quality of all the commercial loans that these banks specialize in.
We need to watch geopolitical shifts, specifically around potential tariff policy changes. If higher tariffs squeeze corporate profit margins, especially for businesses in sectors like retail or logistics, those companies might default. And regional banks are highly concentrated in lending to those middle market businesses.
So the risk gets amplified for them.
It could be amplified well beyond what the large globally diversified banks would experience.
Okay, let's try to ground this discussion in the market's performance. Let's look at the KBW Regional Banking Index, the KRX, over the last year. How has this battle between hope and fear actually played out technically?
The KRX index is. It's a textbook example of volatility driven by these conflicting signals. It rallied sharply into February 2025, peaking near 129 on rate cut anticipation. But the volatility that followed is really what cemented the discount.
What were the biggest interruptions?
We saw a sharp 9.8% decline in April's 2025. That was due to political risk around tariff announcements. And then there was a brutal 6.3% single-day decline in October.
Just one day.
One day. Specifically on credit stress concerns tied to a couple of high-profile bankruptcies, it just wiped out confidence and drove prices right back down.
So if the volatility is that intense, is there any constructive signal in the index at all?
Definitely. Despite those really sharp dips, the index has established a series of higher lows. It was 109 last November, 102 in March, and then 111 after that October scare. Support seems to be consistently developing in that 115 to 117 range.
Which suggests that while investors might panic over headlines, the intermediate-term trend is still structurally intact.
It seems to be. So if we assume the macro backdrop cooperates and the earnings growth materializes, a mean reversion is the most plausible outcome.
Back towards those prior highs.
Exactly. If earnings deliver on that 16% to 18% growth forecast, a mean reversion toward the 130-140 range on the KRX is entirely plausible within the next 12 months. The sector is priced for failure, it's haunted by past scars, but the mathematical evidence is increasingly supporting prosperity.
So for the long-term patient learner listening to this, the key question becomes one of identification. Which specific institutions, the ones with the best deposit franchises, lower CRE exposure, disciplined management, which ones are best positioned to capture that asymmetric upside as the sector's redemption arc continues? You have to be selective to win here.
Selecting the strongest balance sheets is absolutely crucial.
See you all in the next Pro Ticker Deep Dive.